The S&P 500 is down 14.71% year to date right now. It is hovering in that $4,000 area. The more tech-heavy NASDAQ, on the other hand, is trading down 21.82% year to date. It is close to that 13,000 level. And now here is a tweet from Bob Pisani, a great commentator on CNBC, on July 30th that says S&P 500 closes July up 9.1%, led by Tesla up 32%, Amazon up 27%, Ford up 32%, Nvidia up 20%. Best month since September of 2020. Hello, what's going on? Bull market. However, maybe not so fast. First off, let's talk about context. Where are we right now in the scheme of things historically for the S&P 500 for that giant growth of that month? So if we take a look here, this is a tweet from Charlie Bolello, and he's got over here at 18th, the 18th best year on record was last month, July of 2022. Right here with a 12.3% gain in 1 month. A few more of those and we are out of this bear market. We are back into a bull market and we're making money again. Am I right? So here is the thing. What about some of these other time periods in here? Okay, December of 1999. Not a good time to be very long the stock market, at least the NASDAQ especially, during let's say a 3 or 4 year period during that time period. Same with 2001. These are when the dot-com bubble burst. Let's see, what else do we have here? Well, we have a little bit of 2009, also not a good one. That was right below us though, so that's good. Now, this is what I want to talk about in context. So this is a tweet from Dan Nathan, who subtweeted Bob Pisani and said, "He who forgets, we will be destined to remember nothing rally." And he links to the old August 28th of the year 2000 article from CNN Money. It's always fun looking back in time and seeing what some people used to think was going on during a bear/bull market, trying to figure out where we are in this whole thing. We don't know until we're in the future, right? Everything in hindsight looks so clear, but right now it does not. So, back then, what was the consensus? Oh, maybe it's that NASDAQ wipes out a 2,000 loss. Gains in last year's winners bring tech gauge to last year's level. Basically, this is saying that hey, we think it's time to be bullish on tech again. Things are back, baby. This is a good time to invest. I mean, look at this quote. Strong corporate earnings and low interest, said Brian Finnery, head of NASDAQ trading at CE Underberg Tobin. When asked about the day's action, everybody wants to own these technology stocks because the earnings growth is so strong. Okay, so let's talk about context. What happens next in this whole thing? What is the next thing that happens? Okay, well, we have the NASDAQ 100 right here, and we are looking back until this time period, October of 1998, which was a few years before when that was published, until August of 28th of 2000. What happens? Well, you're up 274% over that not too long period of time, right? Let's say 2 years. That is a huge percentage return in 2 years. Obviously, anyone would be very happy with that. And if you held that and you were able to continue making that money, or even if it held for a little bit, you would be a very probably wealthy person. If you go now to the next few years after that, okay, that 274% is now right here. Okay, let's go forward now and see where we are. Okay, we are going to October 9th of 2002. Let's go forward another 2 years. What happens? Oh no, we're down 80%. Okay, we went up 274 and we went down 80%. By the way, look, we are lower here than you were when you started in 1998. You round tripped, then you went down even further. So, is that going to happen right now is the question, right? Where are we right now? This is hard to figure out because you look back then, look at that CNN Money article, someone who probably knew the market, knew what was going on, and they thought tech was still a place to own money, to put money into, and we're abysmally, completely wrong, obviously, looking back in history with hindsight. But right now, where are we? I don't know, for example, 100%, but let's talk about this. So here we are. Americans are anxious about a recession as inflation cuts into their spending power. Okay, so people are making less money, and that is not a good thing. So if we look down here, consumer spending may have a big impact on the U.S. economy in months to come, according to UBS, which projects 40% odds of a recession in the next 12 months. Now, if we look back to what happened over the past week, we can see that a recession is probably here. There have been 2 quarters of negative growth, but there's weird stuff going on in the market, in the economy. The economy is basically broken because unemployment is supposed to go up, and it is not. It is totally fine right now. So what is going to happen? Is unemployment going to start coming down, or is unemployment going to be staying at pretty nice high levels? And are we going to start having a recession in a time when unemployment had no effect negatively? That would be weird. This part of the article says 66% of Americans worry that a major recession is right around the corner, up from 48% who said the same a year ago, according to a survey by Allianz Life Insurance Company of North America. Then we have down a little further. Meanwhile, 71% said their wages are not keeping up with their rising expenses. Inflation is eroding people's ability to get ahead. It's not good. That's not what you want to have in an economy and as a society, right? You want to be able to make yourself better off over time. And you don't want all of the things around you that you have to pay for to go up more than your wages do. So over here we have a great tweet from Liz Ann Saunders, who is a personal favorite of mine. So savings rate continues to evaporate, now at lowest 5.1% since August of 2009. So as you can see, we have 2009, we have the Great Recession right here. You go back a little further, you have the tech bubble, you have 9/11 happens in this time period, right? So basically, these are not good time periods, and the saving rate was not good at that time. However, we finally did get some good savings in this country, where it finally got up to the point where we had crazy savings, and of course, that was probably because we were stimulating the economy probably too much. So the time when finally the American workers are making more money, they're putting more wealth in their pockets, things are getting good. They're able to save more money than they ever have. Well, suddenly it goes back down and it plummets, honestly, back to 5.1. So that is not a good place to be, and that could be a signal that maybe Americans don't have the ability to save anymore, right? Maybe what's going on in the economy is really hurting people. So this is another kind of different tweet. This is from Carl Quintanilla from CNBC, Fundstrat. The Cleveland Fed's inflation forecast now shows July CPI tracking to 0.27%. This is a 3.24% annualized, the lowest rate since 2021, a collapse from the 9 to 12% annualized rates seen in 2022. So if we look over here, we see this is July of last month, so 0.27% only for inflation, which would actually be a good inflation print. So if this was to happen and occur for the next 12 months, what Carl's saying is that we would have only an inflation rate of 3.24%, that's a good inflation rate, especially compared to what's been going on lately, when we're talking like 9+ inflation, right? So we don't want to have a 1.32% inflation month over month. We want to have a lower one. And so we do have some positives, we do have some negatives, and at the end of the day, what I want to talk about is the fact that there's always terrible times to invest, right? There's always a bad time to invest. There's always an excuse. Every single time, every single year, there's always a bad excuse. Let's go back. 1950s. Oh, this was the excuse back then. There's a recession. Oh, there's the Red Scare. Oh, the Korean War. Oh, Sputnik. What happens? Okay, over the next 4 years, market ripped higher. Okay, we have a recession again. We have a recession. The Bay of Pigs. We have all sorts of things. Literally, there was almost nuclear war. And of course, you weren't probably very bullish about that time period. But look, a few years later, another ripping stock market. Nice bull run. Okay, things keep going and keep going and keep going. And if you invested during any of these time periods and you look back till today or you look forward 20 years, you're always doing better. So who cares at the end of the day if you're a long-term investor? What do you care? Where do you care in this chart? What do you care where you invested? You want to invest here? You want to invest here? You want to invest here? Look where we are right now, right? And so this is going to continue going upward over time, and we don't know how long it's going to occur for, but we know that over time it's going to. And I do want to give Brian Feraldi some credit for this tweet. He says will always be a smart-sounding reason to sell. So the last thing I want to show you was tweeted by Brian Feraldi. It's from JP Morgan Asset Management. And this is a warning. It's a warning to you and to us and to me, for me to realize that the average investor, a 1.9% return for the average investor, over this 20-year annualized returns by asset classes, this is looking at 1999 to 2008. You saw before how much that you could have earned in the stock market annually over that time. You could have made a lot of money if you just invested in the S&P 500, if you just invested in the NASDAQ. You could have made a lot of money. However, look, REITs were the best performing asset class over this time period, 9.9%. Gold, oil, S&P 500, 5.6%. A 60-40 portfolio, 5.2%. A 40-60 portfolio of bonds to equities, 5%. We have bonds, 4.5%. EAFE, 4%. We have homes, 3.4%. Inflation, 2.2%. And where is the average investor? It lost to all of those. And why is that? Because the average investor doesn't do a good job investing. They get scared. They get scared when they see all of these different things. And so wherever we are right now, if we're here and we're like Carl Quintanilla is tweeting out that things might be looking good with inflation and we could have a great next 12 months maybe, or maybe saving rates are really, really down and this could be a bad sign for what's going on. Wherever we are right now, I mean, it doesn't matter because if you look right here, we are up in this very high area right now compared to this time period back in the early 2000s. All the time, every time, you're gonna make money if you look long term, if you look over the long term, and you just hold it together. So that's all I wanted to talk about today. The bear market might not be over. I don't necessarily think it is. But I do think that this is an amazing time to invest in the stock market. So thanks so much for watching. Hit that like button if you like this video. Subscribe to see future videos like this. Check out my affiliate links below. I got some stuff. Support my channel. And watch another one of my videos on the end screen, please, right now.